Hi everybody, welcome back to the Lending Technology Think Tank. My name's Colin White, I'm from Credit Connect Media. Obviously, for those of you who just missed the last session, we ran a session on credit risk, really interesting session. That has been recorded and we will share that with you, for those of you who missed it, on a future date on our YouTube channel, but also we'll have reruns. If you registered for that, they will be sent out tomorrow. So yeah, really interesting session. But now we're going to move on to our next session of the day, and we'll be looking at measuring affordability. For those of you who haven't joined us before or not in the previous session, we really encourage you guys out there to be as interactive as you can. So have a look at the screen in front of you. There's lots of information and buttons on the left-hand side, but the important one for you to look at is the speech bubble. If you have a look at that for us, you can ask some questions. So that would be really, really good to get that. We also have some information and links for our sponsor of this session, which is Experian. So we'd like to thank Experian for sponsoring this session. But I think we'll move on swiftly. And what I will do is I will hand over to the event chair, Chris Warburton, who will lead us through this discussion and also introduce firstly our speakers for the session. So Chris Warburton, Chris, over to you.
Thanks, Colin. So welcome everyone to the second session of the day on the Lending Technology Think Tank. It's going to be on measuring affordability. So my name's Chris Warburton, as Colin said. So I'm going to be chairing the event. We've got a great bunch of speakers. A little bit on my background. I spent the last sort of 20 years really in sort of risk operations, so within consumer lending across the life cycle. And at the moment I'm director of RO strategy, and we've been spending the last couple of years sort of like exploring some ideas and innovations and series of videos sort of going on in the industry really. So and thank you, Colin, very much for asking me to chair today. So as I say, this session's on measuring affordability. We already touched on it a little bit in the last session around assessing credit risk, because obviously affordability is a big part of that. But here we get to explore in a little bit more detail. I mean, it's going to be sort of critical going forward, affordability measurement, and not just current affordability, but also future affordability, and getting a handle on that in terms of what that's going to be with, the cost of living crisis, energy bills, and all of the changes that are going on at the moment. And with it being such a dynamic environment, one of the things we want to try and explore is a little bit how do we get a handle on that? What data do we need to have? How do we integrate that smoothly within our processes to make sure it's seamless, making sure it's low friction for customers, and yet provides the information we need to really get good sort of risk assessment and prevent foreseeable harm. So with me today we've got three people. We've got James Wilkinson, who's the head of lending for Fair for You. We've got Andrea Cox, who's the affordability director or head of affordability for Experian, and we've got Emma Steeley, who's the CEO of Freedom Finance. And so we've got a great panel. Welcome everyone. What I was going to ask is maybe just give sort of your elevator pitch, introduce yourself and give a little bit of elevator pitch around what you do and what your company does, and then we'll get into the questions really. So Andrea, you're first on my screen. Do you want to go first?
Hi, yeah. So I'm Andrea Cox, Affordability Director at Experian. I've been doing that role now for the last 3 years, which mainly means that I've been working with firms across various different sectors and industries to help them understand how both bureau and open data enables a greater understanding of consumer affordability. So with my experience, so I've been actually in financial services for over 20 years. So with that experience and my understanding of the products and technology, that really helps me to help organisations understand their affordability. And I'm very much using a consultative approach.
Okay, fabulous. Thanks, Andrea. Emma, do you want to go next?
Yeah, great. Thanks, Chris. Hi, everyone. I'm Emma Steeley, CEO of Freedom Finance. I joined Freedom back in July, so relatively new to the role here. At Freedom, we are a digital marketplace. We work with we have a direct consumer proposition, but primarily we have the embedded finance solutions that we power through various partners and introducers in the space. And we have one of the broadest panels in the UK, because we offer solutions for not just unsecured auto and credit cards, but also in the secured space. Prior to joining Freedom, I was the CEO of AccountScore, which was an open banking fintech that we sold to Equifax back in February of last year. But I've been working in the financial services space since 2006. Started off in the consumer lending space. So yeah, affordability is very much kind of at the heart
Bread and butter.
of everything that we've done. Yeah.
Fantastic. James.
Hi, everyone. Yes, I'm James Wilkinson. I'm head of lending at Fair For You. I've been here for about 3.5 years now, including having a brief stint as interim CEO. Prior to that, I've worked at Lloyds Bank, Coventry Building Society and Secure Trust Bank before being lured across by the social mission that Fair For You we're trying to achieve. Fair For You has been operating for about 7 years now, backed by a number of social investors. We provide finance for essential items to those that are financially excluded from mainstream credit and some of the most vulnerable in society. We were set up as an ethical alternative to the rent-to-own and high-cost short-term credit doorstep lenders. For Fair For You, I guess the landscape's changed quite a lot over the last few years. A lot of those lenders that we were set up to combat have left the market, so there's now something of a vacuum in the space. But we have partnerships with Hotpoint, Whirlpool, Dorset Homes, and more recently Iceland Food Stores, where we provide an interest-free revolving credit microfinance to help families feed the kids during school holidays.
Good. Thanks very much, James. Appreciate that. So I suppose to kick off, I suppose it's just generally, I suppose, how are you guys sort of seeing the role of assessing affordability and vulnerable sort of changing at the moment? I mean, we've been through quite a turbulent period. I would say the last couple of years that more than most of us can ever remember. But I mean, how are you seeing that changing, and how's the role of assessing affordability kind of changing? I mean, Andrea, I mean, it's what you kind of do from a consultative approach. I mean, what have you been seeing?
So obviously in the last few years, we've seen quite a lot of focus on affordability and measuring affordability, driven by a number of factors. Firstly, regulation. So obviously the regulators have been very keen with changes to CONC, make sure that lenders effectively measure creditworthiness, including affordability checks, and have been doing a number of supervisory visits. There's obviously also the new introduction of consumer duty that's going to go live next year, that will be implemented by July next year. And that has a significant impact as well. And I think a change in the way which we should measure affordability. But alongside that, there's also economic problems. There's been issues. So firstly, we had the COVID pandemic, which caused an impact on people's income because of furlough schemes, etc. And more recently, all conversations are focused on the cost of living crisis. So the expenditure element of that affordability equation. How is the cost of living crisis going to impact the expenditure of individuals across all of the different income bands? And as you're aware, in focus now, I think from an affordability perspective, is trying to truly assess an individual's non-discretionary expenditure. So how can individuals tighten their belts? What changes in behaviour are we going to see as a result of the increase in fuel prices and also food, etc. So there's been a lot of changes, certainly in the last few years, like I say, based both from a regulatory perspective, but also the economic and social stuff.
I mean, I suppose, and Emma, coming to you, I suppose you've been at the forefront of some of those changes, both with your prior experience, and then I suppose what you're kind of seeing now as well, in terms of, I mean, there's a technological change, but I mean, there's also sort of like maybe even the way consumers are reacting in terms of understanding and sharing information as well.
Yes, absolutely. What we are starting to see, from Freedom's side, is there is a desire from our panel that actually, it's us that actually helps with that assessment of affordability up front, because the consumer is applying, and the majority of finance is applied for through, the third-party aggregators in the UK. So there is a desire for more checks to be done up front. I also think there is now an argument that affordability potentially comes before creditworthiness, because it's about understanding what is in the now. It's no surprise that I'm a big supporter of open banking. That's what I did for years, and I think that gives that current up-to-date view of the consumer's finances. But also, I think what we're also starting to understand is that where customers may be vulnerable or just really struggling, what they want is honesty and being given the information so that that it's clear and transparent, so that they are able to start to take action. They don't just want stats put in front of them. There really has to be sort of guidance actually provided to consumers to understand, okay, where can they make these cuts? What action can they take?
Do you think the bar's being raised, I suppose, from a business point of view? I think, Andrew, you just mentioned around the regulator, but which is certainly being raised, but from a business point of view, in terms of understanding and the accuracy of affordability than it was 10 years ago. And I suppose, what's the impact then as well around what the consumers expect as well in terms of being able to share that information? I mean, is the bar being, we've just been raising the bar the last 10 years.
Yeah, I think there certainly has been a raising of the bar, and like you say, helped also by the introduction of new technology. So the open banking, transactional level information has really helped us get greater insight with less friction. So for example, less need to ask for bank statements and wage slips potentially. So the bar has certainly been raised.
And James, I suppose,
sorry, it's important, as Emma says, to make that, to not only look at that at a decisioning point, so when you're making a lending decision, but also the new regulations and the new consumer duty that's coming in is basically prescribing that you continuously monitor that affordability as well. So it's not good enough just to do it at the point of lending, but also lenders must continuously monitor that, and also not just look at, but also look at the wider implications on an individual's financial situation. So look at, did that lending mean that they had to take new credit elsewhere? Has that meant that they've, taken out a new loan, but actually to pay that back, their actual credit card utilization has gone up? So there's a much wider focus on just income and expenditure. It's much wider than just at decisioning time. It's a continuous monitoring throughout the customer life cycle, which is a big change, I think, for where we sort of the evolutions come from where we were 10 years ago.
So James, I was going to come to you and just ask around, specifically from your sector. I mean, what are some of the things that you've been seeing in terms of affordability? We talked a little about the bars being raised in terms of understanding it more, but when you look at the detail in terms of the customers you're seeing coming through, I mean, are you seeing changes, and particularly if you've seen changes over the last, I suppose 6 months? I mean, sort of like ignoring the last 2 years. I mean, what are you seeing now?
Yeah, I mean, aside from demand steadily increasing as people discover our services, I mean, we made some changes to our affordability calculator during the spring of this year. So we had an external review by an ex-FCA employee, and they, highlighted some things where we should be using, certain types of data that we weren't currently. So we made that change, but it's, obviously going to become woefully out of date in no time at all. So the use of Open Bank has been invaluable in that way of really assessing, the average basket size spent on shopping at the point of application. So we can get that trends, and we need to increase that now because we're only getting 3 months worth of data. We need to go back further to get a better understanding of trends, but no doubt we'll be seeing that, the cost of living has increased in the last 6 months.
Yeah, I mean, things like ONS data, and that came up in the last session, which is, ONS data was always traditionally would use it, but now that just seems just like woefully out of date. I imagine if we get into an inflationary sort of spiral, I mean, they're talking about inflation now being higher than it was in the 1970s. There was a comparison like for like, I think I saw. I mean, it could potentially be like that. I mean, how much can we rely on the existing affordability sort of systems we had versus not, and then what do we need to do about it?
Yeah, I mean, that was the recommendation from the external review we had, is we should be incorporating ONS type data. I mean, I was using that 10 years ago when I built a model for the Coventry Building Society. But as you said, it's woefully out of date, and it doesn't account for inflation in the last 2 years, 3 years. So you have to factor all that in. And I guess historically, we weren't that precious about inflation on a micro loan for 12-month term, because we got such a high churn rate of our loan book. But now we have got to factor that in, because our customers are the bottom couple of deciles, and income shocks are going to hit them hard. Although we have a good customer loyalty, they will prioritize putting food on the table rather than repaying us.
Yeah, and I was going to come to you, Emma, just in terms of like affordability assessment, because now we have to think a bit about not just current affordability, let alone sort of ONS data, which is historical affordability. It's sort of like current affordability, but now also future affordability. I mean, how are you thinking, or how should we think about factoring future changes? So the last session we talked a bit about energy costs and what's going to happen this week. Will there be a support mechanism? But I mean, like, all of these things could still change. We don't know how they're going to change, but how do we factor that into assessing affordability, assessing, I suppose, resilience, really, I suppose, to be able to make payments back for the loans?
Yeah, absolutely. And I think that people's finances are potentially more brittle than they've ever been. And so there is no silver bullet at the moment to turn around and say, okay, we know that this person's circumstances, because we can see they've looked like this over the last 12 months, are going to look like this in the next 3 to 6 months' time. So to Andrea's point earlier, for me, it is about that customer life cycle and that continued monitoring. And I think there is a fine line about being able to truly explain that to your customer as well, and again have that transparency with the customer, that they don't feel that you're being invasive, but that what you're able to do by monitoring their circumstances and having that data on a daily basis means that you have to, as a lender, have that responsibility to adjust your terms. And the lenders need to be able to do that at some pace. Yeah. And I think that is definitely more challenging than me just sitting and saying that's something that needs to be done. But where you are seeing, if somebody has had an income shock, or you've seen that, we've seen sort of on cost of living as well, compared to sort of July last year to May this year, BNPL is being used by sort of 33% more consumers. And so when you're seeing these trends happening in the market, you have to be able to react, and you've got to use the monitoring technology and your communication with your customers to be able to change how you treat that customer.
And I suppose some of that's going to be loan type dependent to a certain extent, like secured loans or taking in a secured mortgage at one end, like a secured loan, versus a credit card, which you can sort of adjust limits and those kind of things. But it still becomes quite difficult conversations, I'd imagine. And it's quite a hard conversation to have with someone, which is actually, we need to change your repayment terms, or we need to change your limits, or those kind of things. I mean, how do you think about that, I suppose, in terms of that ongoing customer lifecycle management? There's an ops element, isn't there?
And I think, it is that customer lifecycle. And I think that trying to sort of sit under the radar, those times are gone. It's not a case of, right, the customer's had a loan and then you don't want to converse with them until that loan is paid off. That's not the way the world works anymore. It's more important than ever to be building that relationship with your customer and understand it, and so that there becomes an understanding that should they need to borrow, it is you that they will want to come to, because you've treated them as an equal. You've had the respect to have those conversations, and the conversations aren't always easy, but if you're putting the customer at the heart of the conversation, then you tend to get a mutual respect.
Yeah, and there's a long-term brand impact, isn't there, to having that? I mean, Andrea, good to get your advice, I suppose, just in terms of like having those conversations, but also in terms of like, what are some of the indicators to look at in terms of that could be having like issues with affordability, those kind of things, because we've got access to a much wider suite of information than we've ever had before.
Absolutely, and I think data is key to understanding this. and data from various sources as well. So I think, we've been doing quite a lot of work recently on identification of financially vulnerable customers, not only because of cost of living, but also cost of consumer duty. And there are various behavioural indicators that you can get from data to show whether somebody's entering in financial stress. And they could be across all sorts of different lending products, like you say, unsecured or secured. And the types of things really that the lenders should be looking for to identify financially vulnerable customers are arrears statuses, but across all lending, not their own book, not their own loans, persistent debt type measures, more than their actual income, and any additional borrowing. So are they using their overdrafts differently than they have previously in their current accounts? Have they increased their credit card utilization? Are they paying their credit card differently? Before were they full payers? Now are they going down to be minimum payers? And things that you can get from open banking data, such as have they started paying their utilities bills on their credit cards, whereas before they were on a direct debit? And obviously other things from open data that you can see is cancelled direct debits or unpaid direct debits. So you have to utilize all of this data to really get a whole picture of an individual's financial situation, and also to them. Does that answer your question? Does that help?
Yes, you were breaking up a little bit there, and on my side at least, anyway. But yeah, I mean, because there's other things. We were just chatting on the last session around things like, are people cancelling subscriptions as an example? And there's like, is there like a whole new layer of sort of indicators that we can look at? I think we talked about gambling, but also like the order in which they might be paying their utilities, or the order in which they're prioritizing spend, and those kind of things. I mean, is there another layer of sort of sophistication that we could be looking at, do you think?
Yeah, I do. I think that the traditional measure of affordability, understanding someone's discretionary income, it's about understanding those behavioural changes. It's those really key alerts and indicators of change in people's spending habits, and the change in which they're using credit, that is really important now, and that we should be focusing on, especially to make sure that we're getting a good customer outcome. And as Emma and I have both said, to continuously monitor that is really important now.
Yeah, and James, I was going to come to you. So obviously you've got a slightly different segment in the market. I mean, and I think we previously had a conversation around that segment's actually quite good at budgeting as well, which is the whole sort of budgeting kind of aspect to it as well versus not. I mean, what are some of the leading indicators that you think you could look at, and does it change by segment or demographic as well? I mean, are you seeing a change in that?
Yeah, I mean, as you say, our customers have become something experts, very competent at managing their finances. They've learned from previous mistakes. They know what's going in and out exactly, and they've become budget experts. They also, quite a lot of them are very good at alerting us when they know they're going to have a problem, which is great, because we can then be on the front foot, and we already have a very flexible repayment plan in place. And so customers can change their repayment frequencies as long as they don't go into a default state. Then we're very happy to help them juggle their finances with us. In terms of what's changing, I mean, we're probably not far enough down the open bank journey yet at Fair for You to be looking in that level of detail, if I'm brutally honest. We do pick up gambling, return direct debits. We look for those sort of key indicators, and income fluctuation, but actually income's quite resilient for our demographic because they're primarily benefits dependent. We know next April, benefits will increase in line with inflation, but that feels an awfully long way away at the moment. So yeah, we'll obviously have to see what the new PM is going to deliver in that sense.
Yeah, and obviously you mentioned your deal with Iceland. I mean, I was talking about food on credit to a certain extent. I mean, I suppose there's a danger there between sort of like when people buy food and then does it roll over into future months. I mean, and I know you talked a bit about that's really not what you've been seeing, just in terms of like people using it to spread it over within a month. I mean, how do you sort of manage that balance between the two, between people smoothing payments versus people borrowing over the longer term, which can be more of a risk, I suppose.
Yeah, I mean, the way the product's designed, it's never going to have, you know, an increased balance on it. It's a maximum £100 on there, and if the customer is able to pay that down during the term time when the kids are being fed at school, then they'll be able to top up that card during the next holiday period, so half term or Christmas would be probably the next one. For us, the risk is low. For the customer, you know, it's interest-free product. It is just there to cater for those emergencies and to enable them to do a big freezer shop. That's the holiday period.
Yeah, and I know you guys aren't buy now, pay later, because that was a misconception I had, right? So it's definitely not, and it's FCA regulated and all of those kind of things, good things. But I mean, I suppose just on a wider perspective on buy now, pay later, maybe ask Emma to maybe to comment on it. I mean that's been quite hidden, I suppose, from affordability for the longest time. I know one or two of them are starting to report now, but I mean, how much of an issue do you think that is? I mean, is it really not that big in the grander scheme of things, or is there a hidden expenditure there that we've got to be aware of, which I suppose open banking to a certain extent can kind of help with?
Yeah, absolutely. And I think it is something that everybody is aware of. We've definitely seen huge growth in the BNPL market, but I don't think it's a case that you can say, oh, okay, yes, because somebody has 3 BNPL accounts, this means this, because actually, going back again to Andrew's point, it's about the behaviors of the customers and actually what if you're seeing a shift in it, because a lot of actually what you see and what I've seen historically in the open banking data has been that the customer will buy something on BNPL, then all of a sudden you'll see a bunch of refunds, and in that case, what they're really doing is using it as like a trying on fitting room, a virtual fitting room, and sending everything back. So you actually have to look at it in the wider context as well of what's coming in as refunds, what's actually going out, and then it's balancing it again through. So where it is what's critical is about understanding what is shifting and how much it is shifting in comparison with everything else that is going on with their finances as well, and that's where the CRAs really have got play their part.
Yeah, I mean, the way you just described there really sounds like a segmentation issue within a segment, right? Which is like how do you further segment? I mean, have we got enough segments? Andrea, I suppose the answer to that is probably no. I mean, what more can we do? And how do we need to think about how we segment affordability and maybe put it into like even more buckets and more fine tune it than we've got today?
Yeah, so obviously, as you're aware, buy now, pay later information is going to get shared very soon with CRAs, and the whole reason, and it's going to be kept separately from other credit data, and the whole reason for that is so that we can learn and understand from that. So it is going to be in a different segment to our other affordability calculations, so that we can learn more about that and understand. I know buy now, pay later has previously been linked to similar behaviours of high cost short-term loans, but our research and our looking at data suggests that it's not the same market. People who I use buy now, pay later because I can get buy clothes over 4 months rather than have to pay it out in one, and that's just because it's interest free. And it's easy out there like me who are not in financial difficulty who will use buy now, pay later from a convenience point of view. So it does have an impact on affordability. We do have to be careful how we treat people from an affordability perspective. And we do have to look at how they're utilising that buy now, pay later. So how many loans do they have? Are they using it more frequently? And again, we come back to the same old, it's a behavioural change. We have to look at that in the context of an individual's behaviour, and also
you dropped in and out a little bit there, Andrew. But
sorry, my internet connection's terrible. Sorry, I'm trying my best. But yes, it is looking at it buy now, pay later, transactional information and credit alongside other metrics as well.
Yeah, and I suppose some of it's around how do you separate out the buy now pay later person who does do refunds or is using it one way versus someone who's then using it as credit, and like how do you actually separate that, which becomes is there extra information we can use to try and do that.
Sorry, well, just one thing I'd like to say on that, when you talk about sort of segmentation, to a certain extent, I think that segmentation, it's always kind of going to be there, but it's kind of on its way out. And that's because the consumer, when they are borrowing, they want a personal experience. Like we want personal experiences from our banks. And actually, there is more and more data becoming available. We all talk about open banking, but you look at sort of HMRC APIs, you look at income verification data, that the bureaus are working on as well. And actually, there is going to become more and more data available that is the consumer's right to share. And if the consumer is sharing their personal data in order to get a lending decision, it should be a personal decision as opposed to a you fit in this block. So I believe that's the way that affordability is going to shift and just lending in general.
Yeah, so sort of narrowing it down so it becomes even ever smaller, almost like down to the individual eventually.
Yeah, why not?
And I suppose, with all this talk around, I suppose, affordability assessment, one of the big challenges, and James, you mentioned it, is around like how do you integrate all this stuff into your processes, either from an adjudication and origination acquisition point of view, all the way through customer lifecycle management. I mean, how far evolved do you think we are? How much further do we need to do? And what I suppose, what are the tips around starting that process around putting some of this infrastructure in place?
Yeah, I mean, our affordability and credit risk assessment is primarily application-based, credit reference agency and open bank. I like that blend. It works well for us for the size of loans we're doing. I don't want it to be too much more complicated. We've looked at alternative data sources. We've looked at a secondary bureau to try and enrich our data. All things that are still pretty much on the table, actually. We're just getting our priorities right in-house for that. We are focusing more on open bank. As I mentioned, we're going to increase to 12 months worth of data so we can get better affordability assessment in place. One area where spoke with Experian actually was around the rental exchange, because a lot of our customers are social renters. We were very interested in that, but I don't think the take-up's been there to report that data in. So unfortunately, I think when we did the assessment with them, about 10% of our applicants are on that database. That would be really interesting extra data to see if a customer is able to maintain their rent or it's being paid, so they're not falling off plan there. We have a decision engine where we can plug and play pretty quickly. So great. The only challenge for us is time and money. We're only 23 employees, don't have deep pockets for R&D. And there's a risk that, we try things and it doesn't work. We'll accept that because we're trying to be innovative and disruptors in the sector.
I mean, you raise a good point there in terms of, like, I suppose, size of book and complexity. And we love to talk about like all the things you could do, but there's also a realism in terms of like segmentation of one or individual decision making. I mean, typically can require quite a large book to do it sort of like systematically or technology wise. I mean, how big does that need to be? I mean, Emma, I'm sort of looking at you to disagree with me on that. I mean, how big do you need to be? I mean, can you put it in for smaller businesses, or is there's an economy of scale where it's not worth putting some of this technology in or some of the finer nuances in just from a cost effectiveness point of view?
I think you'll find that the smaller companies find it much easier to implement these kind of solutions because it's just APIs, and it's actually the larger institutions that have so many challenges and are the ones that need to focus on that prioritization. To say, right, this is what we now believe is critical. And it always has to be led by regulation when it's the larger institutions. And, I'll sit and say to one of the banks, this is just an API. And they'll say, well, that will take us 3 years to do. And so that is where the main challenges are. I think everybody wants to be moving forward. Everybody recognizes that there is an opportunity to really shift how they are assessing their customers. But it is about how much funding is in place, what priority is it, and does the regulator say they have to do it or not?
Yeah, you mentioned the dreaded L word there, which is legacy systems. So I think which we all kind of like suffered from a certain extent.
Yes.
And I suppose that, and Andrea, I suppose, I mean, if there were tips or a sort of recommendation about how do you start that journey, how do you start going about that journey in terms of like APIs, in terms of thinking about it and putting some of these things in place, if you can get the funding.
So from my perspective, like I say, I take a very much consultative approach to affordability, and every lender's needs and situation is different. So absolutely, we have to treat each lender individually as well. So and it also comes down to proportionality as well. So not just technical ability, but actually what is it that they're doing. So for example, if you're a mortgage lender, then you would expect that you would have to have a much more granular level of data and a much heavier reliance upon things such as open data, etc. So there's much more granular need for data. So therefore that informs your technology requirements as well. Whereas if you are lending small value over a small period of time with very little interest, then you can do a much more light touch assessment using less intrusive sort of technology. So it really is that overall assessment of individual needs and also what the lenders are doing, including their current technology and also the type of loan and customers that they're lending to.
Yeah.
Not
So
a
it's
one
almost like
all.
Yeah. So there's almost like a value at risk kind of assessment you're doing there in terms of the implementation from a consultative point of view. And we talk a lot about technology, but what about process design and in terms of like embedding this in our process? I mean, how much do we need to think about process design, the customer journey piece in terms of actually gathering that piece? And we talked a bit about acceptance and value exchange on open banking as an example. Like, how do you get people to sign up? How do you sort of think about making this affordability assessment, I suppose, as frictionless as possible? And James, you're not in there. Maybe take that one.
Yeah, I mean, historically we used off-the-shelf credit risk agency solutions for our affordability and scoring. They didn't work, so as a consequence, we were having to manually review an awful lot of applications when I arrived. We kind of then figured, well, actually, there's no better data source than our own. We had enough customer history to be able to then build our own in-house scorecards and make our own affordability assessment. So we spent time investing in that and getting that built. We then incorporated Open Bank, which is pretty much automated. But again, as we still don't quite have that confidence level to auto decision off Open Banking yet. And also we have the reticence of our demographics sometimes being reluctant to embrace the open bank technology. I think they've been scarred by the high cost lenders, the predatory lenders of the past. So we still only get about 60% take up on open bank, which is very frustrating when people would rather send photos of their bank statements in than going down the automated journey. So we're trying to, encourage that kind of process so we can start automating a bit more.
And is there a behavioral or a process design element that you can do that to try and encourage people to use it more, do you think? Or have you explored some of that stuff?
Well, we're trying to get the messaging right at the point of application around you may be sent down this journey. We certainly see younger demographics are more keen to embrace it, older people more reluctant. But yeah, we're trying communications. I mean, I think it'd be wonderful if it was like had a sort of central kite mark that this is an accredited process, because there's an awful lot of open bank providers. When I've tried shopping around, there's about 80 or 90 out there that I can see in this country, and I wouldn't know which one was a good one from a bad one. So how does a customer know that the one that we're using is legit? I suppose. I think it's that getting that established.
So Emma, I'll get you to comment on from a freedom finance point of view, I suppose, just in terms of like some of the things that you've looked at from I suppose really trying to get people to incent people to look at the customer journey. How do you make it as the affordability process as frictionless as possible? And then maybe also explore a little bit around that value exchange in terms of sign up for open banking, I suppose, or some of the tools that James just talked about.
Absolutely. I mean, and in terms of frictionless, I think there is an argument that things don't have to be frictionless anymore, and actually can that instill more confidence by it not being completely frictionless. We all know that if somebody is super prime and their credit score is fantastic, they're going to go straight through and they can get what they want. That's not what we're talking about here. This is really about having that valuable affordability assessment. And in terms of kind of the friction that is introduced from open banking, I remember the banks at the beginning of open banking being launched talking about positive friction, and the app-to-app redirection is super strong. A lot of what it is now is around the terminology that's used. No consumer needs to know that open banking actually exists at all. It's a terrible terminology that we've introduced as an industry that the consumer doesn't need to know about. What it is a digital bank statement. And it's about going through that process and ensuring that you are making that customer feel safe. As long as that customer feels that they are in control of their data and they feel safe, then they are happy to be able to share their data. You are always going to get the percentage of consumers that will say that they don't want to share. That's the way the world is. But actually, when it comes to that value exchange, and being able to either provide a reduced rate or offer a product to that customer that they otherwise may not have got, I think is something that's really important. And what we're seeing at Freedom and what we do is we have one application form, and we obviously take into consideration, okay, what does the customer ask for over what term? But actually, when we look at all the data, and actually when we go, okay, we actually see that you should probably do this over 2 years as opposed to 1 year based on the data that we're seeing. That's being honest back to the customer. It may not always be what somebody wants to hear, but you're trying to ensure that future proofing for them, that they're not going to overstretch themselves over the period that they were initially thinking. So lots of thought processes like that.
Yeah, so it's almost like gathering the data to have a dialogue as much as making it as frictionless as possible. And I suppose a little bit of friction sort of makes the product to a certain extent seem a little bit more valuable. If you've got to do a bit of work to get it, then you sort of like, that you get a little bit of selection that goes through that process as well.
Yeah, absolutely.
Yeah, I mean, Andrew, what are your kind of thoughts on that in terms of like how do we start to integrate some of these things into the processes?
So I think that again, I come back to
a process design element, I suppose, is really
there is, and again, I come back to consumer duty, because from a regulated perspective, I think that will become that's part of the rules now. So ultimately, when you're looking at what products to offer to consumers and include and adapting your policies and procedures, then you have to take much more information around what the potential outcome is for the consumer into account. So I think the regulation around consumer duty will actually speed that part up as well, around enforcing lenders to carefully consider that the product at the point of offering the product is right for that consumer and their financial circumstances. So I think we'll see a move anyway. It's really important to really educate your customers and ensure that they have a really good understanding at the point of offering a product, what that means for them, really getting them to understand how much that's going to cost them. And as she says, offer advice to say, well, actually, you are better off having it over a longer period, because that will help your wider financial situation. So I think in the next couple of years, we're going to see an even larger shift to that more customer-centric product offering, informed by data and technology.
And I suppose we've always seen to a certain extent that people's on the application form seem to be terribly optimistic around future expenses, future income, what their future is going to look like. And certainly if I go to the back end in the collections world, people are incredibly pessimistic on income and expenditure, like the whole world's sort of falling apart. And it's sort of like the truth is probably somewhere in between, which open banking has kind of helped us with. But I suppose that to a certain extent, though, it sounds like from what you're saying and what you're saying, Emma, as well, which is the communication around that future look and being honest around what the right product is, from from an economic point of view, from a customer point of view, to avoid detriment is now more important now than it's ever been, probably in many years.
Absolutely. I think so if we look at the future forecasting, I think Emma said earlier, it's so difficult, right? There isn't, and it's constantly changing. So obviously I work in affordability day to day, looking at affordability, income and expenditure models. And we're always looking at how we can take into account that future forecasting. But for example, this week, we don't know what's going to happen in November now. We've got a new Prime Minister, and maybe on Thursday we'll be enlightened as to what's going to happen later on this year and the beginning of next year as far as the fuel cap's concerned. So all of those things we have to be cognizant of those when we're looking at affordability and looking at future modelling. But ultimately, we have to be reactive to change. So it's not. If you were offered someone a loan, a 5-year term 2 years ago, you had no idea this was going to happen. So you have to, and most lenders do have a buffer that they put in place as well when they're making lending decisions. So maybe it's just a case of having larger buffers when looking at what an individual can afford.
Do you think we need to put that in now going forward, just with the uncertainty it's gone? It's almost like I'm talk about standard deviation, but like the amount of range that sort of change, those things are changing by, has increased dramatically, right? And so we might have operated with this narrow range and like we're going to prove people on the margin, but now do we have to have a much bigger range from almost like from a risk appetite point of view? I mean, and do you think people in the market are going to put that in?
That's already happened. So that's already started to happen. So that sort of started happening at the beginning of this year, where additional buffers were taken into account as a result of the growing expenditure inflation. I think what we need to do now, and this is again a really difficult part, it is so you can do that at a portfolio level. You can do that across the board, and maybe even, like we said earlier, segment it by income or something like that. But the reality is, to get a really true view of someone's non-discretionary expenditure, you need to look at individuals. You need to understand an individual's financial situation and circumstance. So, within models that we've got at the moment, and even within open data, you're looking at someone's existing spend. What we need to take into account and try and assess is how they can adapt their spending and their behaviours. So would someone stop shopping at Waitrose and instead go to Aldi? So there's all of these tightening of belts that people can do, turning down their thermostats, reducing their energy bill. We have to monitor that data and look at people's changes in behaviours over the next 2 years to truly understand the impacts of these economic factors on people's ability to budget.
And the one topic we didn't really talk about, I suppose we mentioned financial vulnerability, but just generally in terms of vulnerability as well. I mean, is that something that we can do? And can we do some of this stuff digitally? I mean, we all talked all about digital here versus manual, right? And just there, you're just talking about we have to assess a person's individual, characteristics. I mean, how much can we go? How far can we take digital? We always want to take it to the end, but is there a role for manual interaction there? And particularly if you get into things like vulnerability assessments as well.
I absolutely think there's a role for manual as well. Don't get me wrong, I'm a big believer in so much automation. The financial services world still surprises me for so much lack of automation that it has. But there are always the triggers that says this person needs a conversation. And it is about having the conversation and making sure that you are signposting that person in the most appropriate way. So there is never going to be a complete replacement for humans in this space, but it's about understanding what is happening, what behaviors you're seeing, and what triggers are being created in order to ascertain whether this customer needs a phone call. And it's not always about actually hearing a voice either. Sometimes it's just like having the web style chat that is not with a bot. Oh, the bots frustrate the hell out of me. You're like, no, you didn't answer my question. But sometimes people still want to have that layer of anonymity that they feel when they're able to just type, but converse with a person, as opposed to be a bot or everything being automated on the data.
Yeah, I mean, what's your kind of view, James? I think you mentioned before in some of our pre-conversations that you had a more manual process. You tried to start to automate it. I mean, what's your thinking around sort of where that line should be drawn?
Yeah, so historically we had a welcome call with every new customer to Fair for You. Returning customers would have a more frictionless journey because we were more confident in their behaviors. But yeah, new customers would always have a welcome call where we'd just check they understood the agreement they were signing up to, the repayment term was correct, just validate that extra validation of income. We have removed that because it was a barrier to conversion. So we have it for thin file customers at the moment. And we have it it's always there as an option for a customer. We also have other channels as well. So we have a web chat, we have email dialogue, if needs be, with all of it, well, any customer really. And we always try and be on the front foot. And if we do detect that customers are falling off plan, we'll start that email process early.
And what about the question around vulnerability? I mean, is there anything that we can do from a vulnerability point of view? I mean, it's quite difficult, isn't it, when you have, shocks, like life shocks that kind of come out of nowhere for folks. I mean, but do you think there's anything we can do to get better insight into that?
Yeah, I mean, almost as a default position, we consider all our loan book to be pretty vulnerable individuals. They're the bottom couple of deciles, which makes up 20% of the UK population at the moment. And although, as I said, they're pretty financially savvy, they if they have an income shock, they have little resilience. So that's where we've had and built this really strong relationship with our customers, so they do feel they can come back and say, look, I can't make this week's payment, I can't make it for another 2 weeks time, and we're like, that's fine, excellent, you can make up the difference then. So yeah, we have all our channels open for those kind of conversations about making our process super flexible.
Yeah, I mean, Emma, just like you were going to jump in now, to a certain extent, I was just going to comment. It comes away from sort of this capturing data to avoid detriment, doesn't it, to a certain extent? I mean, you're going to jump in on vulnerability? I mean, the definition's kind of changed to a certain extent, but how do we understand the customer situation, I suppose? Yeah,
and I think that again, without risking sort of repeating myself, there is no sort of silver bullet in the data. You get a good understanding with the data points that you have. You see shifts in behaviours, and you need to have the right people putting in the right calls at the right time. It's not easy to be able to do it and understand exactly when, and everybody's circumstances are different, and some people will proactively engage, others will be looking to maybe just turn their back on it as well, and not wanting to face it. And again, it's very different conversations that need to be encouraged, and it's about having that open dialogue with the customers.
Yeah. Okay, we're almost at time. I suppose I just wanted to go around and say, it's like just looking to the future in terms of like if there are one or two things that we need to sort of like concentrate on or have people thinking about as we go into sort of like the back end of the year. I mean, given that we've got change in government, we've got stuff happening on Thursday, we've got energy price increases that are going to happen in October, but then goodness knows what's going to happen sort of going forward. I mean, what do you think we've got to be focused on as an industry over the next sort of like 6 months? And I'm going to go around with James, maybe just talk from your perspective.
So at Fair for You, we need to make sure that we are absolutely totally available for our customers. All those that we've onboarded that have been with us for a long period are going to have a pretty rough winter. As I said earlier, there is light at the end of the tunnel in April when they will see a benefits increase. But that's a long way away. So we'll be opening up all our channels to try and get people on kind of flexible repayments, pretty much like we did during the pandemic for those that were suffering income shocks as a result of COVID. So we'll be we'll be having plans in place very much similar to that.
There's a theme around flexibility almost,
Yeah.
right? Making sure you have flexibility and then making sure you've got the right processes in place. Emma, maybe come to you next.
Yeah, for me, Freedom, it's about really engaging through data with our panel and, of course, with our partners and introducers as well, because every time a customer is coming to Freedom, whether it's direct to site or via a partner, they are looking for finance, and that means that we need to find the right solutions to serve them. So it's very much about really aligning on a strategic perspective with our lenders and with our introducers to make sure that we're putting the customer back at the heart of it and starting to move towards that, making it personal sort of process within the industry.
So like personal, honest decisions. I kind of took away from some of the things you were saying, and maybe Andrea, for what's your kind of view as you look out into the sort of into the near term? Really, I usually say next 5 years, but I think we're looking at the next 6 months. Really, what are we got to be focused on?
So I sort of summarize it in 5 key areas where we can help with data and technology. One is the idea of making sure we use all data that's available to identify people who might have very low financial resilience. Second one is making sure we've got proportionate affordability checks, making sure we help lenders with that, that they can use for individual assessment of affordability. Third is getting a good view of income. The fourth is getting a good view of non-discretionary expenditure. And the final thing, the final 5th point really is continuously monitoring and the ability to measure a good customer outcome. So continuously monitoring that through the life cycle of a product to ensure that when somebody's financial situation does change, that lenders can react appropriately and offer them the right services that they need.
Yeah, I mean that certainly came up in the last session around sort of like frequent monitoring, and things are changing so fast. You need to have the monitoring to know that something's changed, right? So
Absolutely.
then you can react to it as well. So that's kind of an important element. So, okay, well, thank you all very much for joining. I think that was a great conversation. So thanks to Andrea, Emma, and James for joining us here today. I mean, I think it was some really interesting insight there. I mean, we're going to see how things change over the next week, even in terms of the next week and so on. But there's definitely things to think about, I suppose, in terms of like flexibility. I think definitely the honest conversation stuff came across, and how we embed that in, I think, is going to be, it's another time of change, really. So we have to see how it pans out the next couple of weeks. So thank you very much, and a fascinating conversation as always. Thank you. Colin, over to you.
Thanks, Chris. Yeah, no, agree with Chris. Really interesting. It's like the conversations we have now change all the time because there's another announcement, etc. So it just goes on and on, doesn't it? But hopefully things will move in a good direction over the next week or so with some of the PM's announcements. But yeah, we're going to carry on with the event shortly in a minute. So we're going to have a brief break, and we've got our next session at 11:55 is going to look at digital lending. For those of you who don't know, we've got our on the 17th of November, we've got our face-to-face credit and collections technology think tank up in Manchester, and that'll be followed by the Credit and Collections Technology Awards. So if anybody wants to get networking again and meet face-to-face, and that's on the agenda, and I'm sure these discussions will have changed even more when we reach that point. But yeah, hopefully you'll join us in the next session. And let me end by saying thanks to Emma, Andrea, and James for their thoughts in that session, and obviously Chris for chairing it. And we'll see you all again soon. Thanks a lot for your time. Cheers. Bye-bye.
Thank you.